Good morning, ladies and gentlemen. Well, I think we will remember these days in the years ahead. Not sure what for, but we'll definitely remember them. Because what is going on is something which I don't think I've seen probably in 30 years of investing. And I am quite frankly puzzled by the market's behavior. All we can do is stick to our knitting and review what is going on and the reasons for it, and try to reach some informed conclusions as a result. The model has improved, but it has not improved hugely. It was in the minus 30s and it's now in the minus single figures. It is still nowhere near ready to give a buy signal. The buy signal would occur when the moving averages cross over, and at the moment they are still here at minus 48. So it's going to take a lot of time, even with the improvement of the market, for them to generate a buy signal. Yet the market keeps on making great strides on the upside, which are not reflected fully in the, not at all in the risk score. I would have thought that with the market behaving as it is, the risk score should be well into positive territory, but it's not. So what we can do is just look at where we are, and this is actually quite an interesting chart to have a look at. This is the deviation from the 50-day moving average. When it's in the green or even outside of the green, it's basically a signal that we are safe to buy equities. And when it gets up to the red area, it is a signal that the market is extremely stretched, and every time it touches the red areas, it basically falls back towards the 50-day moving average, and we are very, very close to that level. That level will be just above 2800. This is where these peaks happened in the past. So around 2810, 2820, which is only 2 percentage points away from where we closed on Friday, around 2775. So very, very close to going from extremely oversold to extremely overbought, all in the space of 2 months. Something that I certainly don't think I've ever seen in 30 years of investing. If we look at the fundamental forward earnings, we can actually see that this kind of rapid recovery has really not happened, certainly not since 2007, and I can positively say that I haven't seen it since the 80s. The forward earnings still keep on coming down, and we are now well through the times 16 Blue Angel, where every time that we went through it, we basically came back down to the times 15. You can have a look at any other period in history, and that has always happened. The times 15 is, below 2600, and now we are very close to touching off the 2800, so we are very close to the 16.5 times forward earnings. This is the kind of stuff that the market is telling you that it's anticipating something. The market is a discounting mechanism, and it's always looking forward rather than backwards. It's basically telling you that either the price is completely wrong and it's a huge opportunity to be short the market, or that the Blue Angels will turn north very, very quickly, and then economic expansion will continue for an indefinite period of time. Now, which it is, who knows? But that's why I'm saying that we'll remember these times in the years ahead, and probably say to us, wasn't that obvious? Well, it's not obvious, is it? We had this week some incredibly bad retail sales figures, which people are explaining away as rogue data because of the government shutdown. Can we say that with any level of confidence? Well, not really. we really need to see some more fundamental data which either revises it or confirms it. And that, so what is going on? Well, people are just buying and buying and buying. And let us have a look at the levels that we're at. Now, if we were in a period of huge economic expansion, you would have thought that the 2-year and the 5-year yields should be going higher. Are they? No, they're just consolidating sideways. And they are ready basically to make a big move at some stage. Now, if that move is down, then all this talk about economic activity is rubbish, isn't it? We are nowhere near. I mean, the 200-day moving average is turning nicely. The death cross has occurred, which is not all that important per se. But the fact that we are staying at these very low levels of yield without any kind of pressure upwards, I would have expected that we would be at least above the middle of the Bollinger Bands, but we're not. We're still in the lower half. We're just trading sideways, a couple of ticks either way with the economic data, and nothing more significant than that. To me, this is a market which is basically doing a triangle, and at some stage it'll break it. My bet is it's going to break it on the downside, and is going to negate all this bullish talk that we have from the equities market. Now, one of the arguments that people make why US yields are so low, in inverted commas, is that it's actually Europe which is driving yields in the States lower. Well, if that were the case, you would have thought that the spread, and this is the spread between 10-year notes and bonds, would be actually going up, wouldn't you? And in fact, you know, this yield is doing absolutely nothing at all. The yield differentials are doing absolutely nothing at all. To me, that is a sign that it's not Europe which is driving the yields lower in the States, but that the States are quite happy to have lower yields. It is very, very puzzling. And in fact, if now we start breaking down, that will drive the dollar lower, and it will also be a sign of incredibly low economic activity in the States. It is, you know, nothing is really clicking into place. To me, the risk on trade can only come on the back of higher economic activity, and the bond market is absolutely giving the lie to that theory. I always prefer to take the signals of the bond market than the signals of the equity market, because the equity market is so prone to mass hysteria, which the bond market is not. To me, the bond market is saying through the spreads and the absolute yield levels that no, economic activity in the States is not gung-ho, and no, we are not going to have a huge move in the upwards in yields in the States. It is very interesting to have a look actually what is happening to European yields per se, and you can see that this 15 basis points to 7.5 basis points level has been a very, very good support for many years. If now we were to break that in the weeks ahead, I say we go to negative yields on the 10-year in Germany, and negative possibly quite a lot, up to 20 basis points. Now that is an indication of recession, not only in Europe, but, you know, if Europe is in recession, China goes into recession. The only reason why Europe would be in recession would be because the exporters just cannot sell anything. The only reason why exporters can't sell anything would be because China is in recession, and the Far East in general. Well, if those things all come to pass, then the S&Ps can be the cleanest shirt in the laundry as much as it wants, but it's still going to go down and down a lot. To me, the dollar is becoming absolutely central to all theses, Because if your thesis is the United States is gung-ho, the economy is fantastic, it's all doing great, the only reason why bond yields are weak in the States is because of European bond yields, then the pressure on the dollar should be very high, and the dollar should be going up and up and up and up, which is a thesis that I've had for a bit. But is it actually playing out? Not really. I mean, we are within spitting distance of the 200-day moving average. We keep on getting reversals and failing basically to go any higher than 97.33, which has been the high for like months, hasn't it, since November. And it's just not happening. To me, a market which fails to go up eventually goes down. And that is the piece of the puzzle which just does not work with this theory that the United States is fantastic and really the problem is the rest of the world. It's just not working. The dollar should be a lot higher and having higher dollar, higher pressure for higher rates, and therefore the currency should be appreciating. It is just in a very tight trading range. When this trading range breaks, something very, very bad is going to happen. It is not breaking yet. We have our levels, we know what they are, we know what we're going to do when it breaks them. But at the moment, this is giving the lie to the theory that the US economy is so wonderful. If we start and have a look at what is going on in the States, this is a chart, weekly chart of the S&Ps. Well, 1, 2, 3, 4, 5, 6, 7, 8 weeks on the trot of higher prices. And, we probably will get a ninth. Why are we seeing this? This is just buying, 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 buying. Is the market telling us that actually QE 25 is coming down the road? That is the only thing that makes any sense at all. That the market is actually anticipating and discounting a new round of QE, which will have much lower yields in the bonds, and the discounting factor in the equities is therefore going to drive equities higher, like it's done for QE 1, 2, 3, etc. I don't know. I have real problem with that. How can you justify another round of QE when you are just doing, you're just going to end QT? It just doesn't make sense. To me, the only thing that makes sense is that people are panicking about missing out on something that there is no reason to panic over. I will be wrong. I will be quite prepared to be wrong. But if we go any higher than 28.11 to 28.20, I would be very surprised. And 28.61 is my my absolute level from a long time ago. And at 28.61, I plan on going against it. Now, at the moment, all I'm doing is I'm winding down my equity positions to zero. But at 28.61, I'm really prepared to go against it in a big way by being short. To me, this behavior is unhealthy. This is just stupid. We are higher 2% on the week when all we had was probably the worst retail sales data, whatever one might say about them, that we've had in in a decade. That something just does not chime, and that is why I keep on saying we will remember these days in a few years' time and either laugh or cry. On a daily basis, if we look at just the INX, we are approaching a very important fib level, which is going to be here at 2812 to 2800. The 78.6 to 76.2. This is the area where I plan to do some options, 78 and then 78.61, which I identified months ago. This is the first level that I really want to do some put spreads. thinking that the market really has to give up at that point. But we will see. So we have our level 7800 to 7812 is where we do some put spreads, and then 2861 is where we really start going against it, because this is getting absolutely silly. We will be above all those levels, even the ones that I showed you in the deviations of the model, and that is where one really has to say that that is it. And that would have even been, I don't know, a 5-way up. I mean, it just all matches up and marries up at this 2812 level. Fundamentally, technically, logically, we really cannot do anything else but stick to our knitting and say this is really getting too stupid for words. The market that's been leading all the way is actually volatility. And as you can see, volatility is doing the mirror opposite of the S&Ps and driving it. But for the past 2 weeks, while the S&Ps have really been going higher, volatility is compressing, and really, you know, the Bollinger Band's coming around 12.5 on the weeklies. You know, we are dead on the 200-week moving average. I would not be surprised to get a reversal signal next week or the week after in volatility, and that will lead us back up. So that is what we should be looking for, and I will tweet to you when that happens. I am a firm believer that volatility will now lead us. As it led us down, it'll lead us, back up in volatility terms and back down in equity valuation terms. It's not often that I show you a chart of gold, but I'm just showing it to you because it's doing basically a triangle, isn't it? This is a weekly chart, so it goes all the way back to 2007. Why am I showing it to you? Because it's doing the mirror opposite of yields. So what is gold trying to tell us? Gold, to me, is trying to tell me that yields are not going higher. If yields don't go higher, and actually gold is probably telling me that yields are going lower, then this has to be risk off at some stage. The only reason why yields would at some stage collapse and gold shoot higher is that something bad has happened to the economy, and I can't see how the equity markets can withstand that. So I'm just giving it to you as another piece in this puzzle, which is just saying that it's very unlikely that yields are going to go up a lot. I'm quite happy parking my money in the shorter end of the curve, you know, the belly 2s, 5s, 7s, and just withstand, you know, just saying I prefer the safety of the return to the investment danger and uncertainty at this level of valuation in the equities. So what is going on that we need to signal here in the biases? Well, nothing in the bond complex, is it? But what we do need to look for is a move here below 0.75 or above 15. Or above 0.15 in the bunds. If that happens, then we really need to follow it, and because it's going to be a big one, have a look at the clip in the video where I showed you those yields. That is going to be important. What did we say here? Expecting major league chop up to 27.25. Right, so moves up to 27.45, 55 guaranteed. Well, we've exceeded that, and now we're saying 28.12 is the first line in the sand, followed by 28.61. You know, there we really have to be very, very proactive. I want to start being proactive at 28.12, and at 28.61 I want to have a major league position in put spreads. NQ is continuing to lose leadership, isn't it? If you have a look at what they're doing, NQ is really doing no better than S&Ps. And that for high beta stocks is a sign. It's a sign that there is no more leadership, or the leadership is changing. And here we are. VIX, well, we identified the 1325 level from the video. That's where we will make a big stand to make it go, looking for the reversal and hoping that it matches these levels up here. European equities are doing nothing much compared to what S&Ps are doing. So 3250, we are there, and I am bearish. I will try and match this level with the level in the S&Ps at 2812, 2861. Too early to sell at 3250, simply because people will trade them together. So I would have thought it's going to be around 3275. That's what I think, but I will try and marry and tweet to you that level when we get to this 2812, 2861. So that is what I want to do. Same theory here. This is what we want to do. We want to be short there when we get to there. The dollar, well, nothing has changed, and this is the really puzzling part of the picture. As I told you, the dollar should be changing. The dollar is the one that should be moving. If all the theories that are out there about why the market is doing what it is are correct, the dollar should be appreciating, and it's not. We still have our levels. We still play the dollar index from the long side because it is what makes fundamental sense, and it seems to work. When we buy it down to at the 95.07, it works. It goes up 2%, but it fails at that up 2% mark. At that 97 level, it always fails. That's why we're saying, yes, we play it long from 95.07, but if it keeps on failing at 97 and coming back at 95.07, one of these days is going to give way at 95.07 and go down to this 93.63, which if it does, it's just going to break apart. I cannot explain to you how important that 93.63 now is. If it goes through there, we're looking for a 10% move. Thank you very much indeed, and I'll tweet to you on Monday.